All right, welcome everyone to a very special edition of Wealth Talk. With us in our 23rd episode today, we've got special guest Kristy Akullian from BlackRock iShares. She is the head of iShares investment strategy for the Americas, based out of San Francisco. BlackRock is the world's largest investment manager, asset manager, is most well known for their iShares lineup of market tracking ETFs. Kristy's a special friend and guest, and we worked together at the start of our career some 20 years ago down in San Francisco. So it's great to have her come on the show and share some views that BlackRock has, which many of our clients will be familiar with some of their ETFs, as we do have those sprinkled in portfolios here and there. So welcome, Kristy.
Thanks so much for having me.
Great. So getting right into it, the market's done a big reversal for Q2. Where do we stand today, and what should we be looking for?
Yeah, absolutely. So, it almost perfectly lined up to the quarters in terms of some of the policy announcements that we've gotten, where we had Liberation Day just a day or two into the second quarter. We've gotten the One Big Beautiful Bill Act passed just a couple days into the third quarter. So looking at sort of that quarter performance, kind of, it lines up really well to the market moves as well. This week is notable because it is 3 months past the pause announcement for some of the tariffs. And it's also 3 months past the local market bottom, if you will. So if you look at US equity performance over the last 3 months, US equities are up 25% from the bottom that we saw just after Liberation Day. Canadian equities are up 20%. So we've gotten this really sharp rebound in where stocks are trading. But I think that one of the biggest questions we get from investors is that we haven't resolved all of those outstanding issues around tariffs and what trade policy globally is going to look like going forward. So one of the most, common questions that we're getting from investors right now is just why, right? Why are equities trading near all-time highs when there still seems to be so much uncertainty in the system? I think that it's important to remember, exactly what the mindset of sort of traders and market participants were back in April. If you'll remember and go back to then, it was almost a foregone conclusion. It was a done deal that everybody thought that the US was heading into a recession that would probably lead the global economy into a recession as well. I think some of the most important changes from that kind of April 8th low up until, the all-time highs that we've seen so far in July here, are that we've really removed a lot of those risks around imminent recession. And so, even though there's still a lot of outstanding questions to be resolved, like what tariff policies are going to be, what we've seen is continued strength come out of the US economy and economies globally as well. So, we expected the unemployment rate was going to skyrocket as a result of some of these policies. And we've actually seen it come down a little bit. We've seen really strong, hard economic data from the US. And then, internationally as well, if we look at different regions, we're also seeing more accommodative central bank policy. So we're seeing interest rates come down. We're seeing economies stay strong. And so I think that took a lot of the risk off the table in terms of, are we really just plummeting towards a recession? And, what should stocks be doing in that case? So even though, there's still questions around trade, the question around recession and the question around the economy and the global economy has been resolved a little bit. So I think that's a lot of what's enabled equities to continue to move higher.
So Kristy, I would agree with that. But I mean, one of the things we're seeing, at least in my view, is that the market's really shrugging off tariff announcements as if they, to some degree, don't exist. So, the last couple of days, we had the announcement on 50% tariffs on copper imports. Now, that was known before, but then we have this new 50% tariff on Brazil over the last 24 hours or so. And the market is just completely brushing these things off. And it's kind of in line with this recovery we've seen, although, the economy is stronger than what was expected. The recession risk, as you said, for now is off the table. It still seems like the market is just pretending these tariffs don't really exist. That's my view, at least.
Yeah, and I think we get a lot of questions around, there almost seems to be a disconnect, if you will, between uncertainty and volatility, that we've seen emerge over the last couple of months, meaning that there's still a high degree of uncertainty. But if you look at different metrics of volatility in the market, and the VIX, the volatility index, sometimes called the fear gauge, is one of those, that's trading below where we were in March. So, to your point, I do think that there's maybe a little bit of complacency in markets in terms of actually pricing out some of these headline risks. I think that part of it has just been that traders and investors have been a little bit conditioned to look through maybe the headline numbers of some of these tariffs, especially as they continue to get delayed and pushed back. So, everybody had July 9th circled in their calendar as that was going to be the end of the 90-day pause. We organized a bunch of client events and things around that, and making sure that we were in front of investors to talk about what tariffs meant. And then, of course, those got pushed back to August 1st, right? So I think that in some ways the market is anticipating some resolution before those actually get implemented. And so you're seeing a big discounting factor in terms of a tariff gets announced at a very high level, but in the reality, what's actually going to be implemented could actually look quite different. And so I think that some of it has to do with that. At the same time, though, we talk so much, and I think it's really fair to say that at least the first half of this year has really been defined by policy, whether that's fiscal policy or whether that's trade policy, and what that's going to look like. But lest we forget, there's also some extremely powerful themes happening in the background. Things like AI, and really how that can improve, profitability and really just change the way we all work. And so I think that it's some of those things offsetting too. So kind of back to that question of how are markets looking through all of this tariff risk, and also how are markets at all-time highs right now. There's some good things happening and there's some bad things happening. And it's really hard to kind of discern or break out the impacts of each. But we're about to head into Q2 earnings season. So we're going to get more clarity on exactly what tariffs mean for companies, but also more clarity into, how the AI theme continues to evolve and if that can continue to enhance productivity.
Well, that's, I'm a firm believer price action it speaks louder than any action out there. And whether it's, broader indices, we're watching certain sectors, being with BlackRock, the largest investment manager globally, where is actual money being implemented? Where are you seeing fund flows attracting to right now? We can talk about the AI theme. I don't believe it's a theme. I don't like referring to that as a theme. I think it's for real. The fact that you continue to see hundreds of billions of dollars invested in AI, but whether it's AI or international, where are you actually seeing fund flows amongst institutional and retail investors? Let's say even over the last quarter, now that you've seen a bit of reprieve on the policy uncertainty.
Yeah, absolutely. And I completely agree with you, for what it's worth. And we do too, as a firm, in terms of kind of the enduring power of AI as an investment philosophy, and also what it's going to mean and the transformative properties. I think we'll come back to that. I'll answer your direct question first, just in terms of, where we've seen fund flows. So we've been tracking this really closely, not only in terms of kind of traditional fund flows, like where are investors allocating to mutual funds and ETFs, which we certainly can see, and we have that vantage point, but even just things like cross-border flows. So are different investors in different regions displaying different behavior than they typically do? And I think there, especially, the answer is yes. A big part of some of this policy uncertainty that we have unleashed into the world is a challenge of that notion of American exceptionalism. And so we've been watching really closely to see, are investors less inclined to invest in the US because of some of that uncertainty and the volatility that is introduced? So if you look at kind of the broad picture of fund flows over the course of, the year to date, so from January through now, we look at global ETFs as just a proxy to get a sense for what different investors are doing in different regions and across different types. ETFs are great because they get used by everybody. Individual investors use them, financial advisors use them, big institutions do. So it's kind of the meeting point to get a really clear picture into what everybody's doing. The first thing I'll say is that fund flows into ETFs are absolutely a record. This is the largest half we've ever seen. We're tracking for a full year record. So there's kind of a preference there. when we look at flows to US equities, for example, they're very similar to what we've seen in previous years. But if you break that down one level and you look at where those flows are coming from, there is a massive reversal in terms of we're seeing fund flows out of European investors, Canadian investors, non-US investors actually dip really meaningfully in terms of their allocation to the US, but we're seeing US investors continue to invest even more so and bring cash off the sidelines to sort of offset. So the top level flows look pretty similar to where they have the last couple of years. The one layer down is that we're seeing a lot more home country bias, a lot more repatriation, if you will, of investors allocating to their home markets. So if we see that continue, I think that could have some pretty big implications. I think that the question that we're still asking is that because of performance, or is that because of another preference altogether, right? Because, as we've talked about a little bit too, there's been a massive performance differential, the largest in almost 2 decades in terms of the outperformance of developed market international equities versus the US for the first half of the year. So I think to some extent, there may be a little bit of performance chasing. We'll need to see how the rest of policy uncertainty plays out to see if that changes behaviors in a more meaningful way when it's not just a performance differential.
I find that interesting what you just said there, and it kind of coincidentally coincides with what we're seeing from a philosophy perspective or a trade perspective, where you're seeing this kind of Buy America theme within the United States from a trade perspective, manufacturing perspective. But outside of the United States, like here in Canada, I know internationally, there's this kind of, hey, we have to diversify away from the United States from a trade partner. The U.S. has been negative towards us as a country, other countries, et cetera. And it just found it very coincidental that those fund flows are following what we're seeing politically and from a trade perspective as well. So I guess my question would be, and I think, we've seen over decades where you've seen significant outperformance of U.S. markets as we have in the last decade. And then we do go through periods where the U.S. is an underperformer globally for a period of time. So, what would be the catalyst for it domestically in the United States for those fund flows to shift, where it's not a Buy America, where it's, hey, it's now time to start to buy Canada, buy international, et cetera?
Yeah, so I'll address it in kind of 2 different parts. So I think the first side is we still have very high conviction that US companies at least remain exceptional, or at least a subset of them do, even if the broader US exceptionalism idea at sort of the macro level is being challenged. So we still see the strongest cash flows being generated. We still see the strongest profit margins being generated in the US and for US companies. So, I'd say as a firm, we do still have an overweight to US equities, but what I think can actually really be challenged is the strength of the dollar. And that's also kind of what we're seeing in terms of some of these fund flows, is that it's no longer a default that if you want to own US equities, that you also need to keep your exposure to the US dollar if you're a non-US investor. So I think we're going to see more demand to hedge. And we're already seeing a little bit of reticence from some of the offshore investor or international investment community in terms of buying, US bonds, for example, especially at the long end, if we're looking at treasuries. So I think that we have to break out a little bit the separation or the differentiation between how we see companies in the US perform. AI is going to continue to drive a lot of that outperformance, we think. We think that, we're still not seeing any competition for US profit margins, at least what's expected over the next couple of quarters. So from that perspective, we like following the fundamentals. We're following the earnings growth, and that is still mostly in the US, it's mostly in large cap, and it's mostly in growth. We do, however, think that we could see the beginning of a multi-year change in terms of the trajectory of the US dollar. So we think that even though it's fallen by 10% against kind of a basket of currencies for the since the beginning of the year, that's the worst start of the year since 1980 for the dollar. Even though we've already seen that, we think that it can continue to fall and fairly substantially based upon some of that demand from other investors to not necessarily hold all of their assets in US dollars. So I'll separate those 2 out a little bit. But even having said that, especially with the investors that we speak to in the US, there is a massive home country bias here and a preference to be overweight US equities. So even after everything I just said about the strength of US companies and where we see earnings growth coming from, we're still telling most investors in the US that we speak to that now's the time to sell a little bit of US exposures and go buy international equities, because we think that that dollar can be a tailwind instead of the headwind that it's been for the last 15 years. And because we think it's really important from a diversification perspective. So specifically, we're having conversations around, you maybe want to sell a little bit of your US small cap exposure. Those companies are much less exceptional. And maybe allocate to international equities as well as both being a diversifier for some of the concentration risk that you get in US equities and some of the valuation risk that you're getting in those large cap names as well.
Yeah, you mentioned the decline of the US dollar year to date. The other unknown is what happens with central bank policy and what's the path of interest rates. And the reason I bring that up because it kind of ties in with fund flows. My understanding, there's something like $7 trillion of cash sitting idle right now, with US yields still attractive on a relative basis. But if the path, let's say going forward for interest rates is lower, that's going to squeeze that yield on what cash is offering. Could that be another catalyst for equity markets continuing some solid performance? Because, and if you're getting 3.5–4% on treasuries right now, and that is, low threes, 6 to 12 months out with $7 trillion of cash sitting idle, I got to think there's a reallocation of capital.
Yeah, the short answer is yes. We completely agree with you there. There's $7.08 trillion in money markets as of 7/8, which was kind of a neat little party trick in terms of the assets and the timing in terms of where they got there. And we really do view a lot of that as cash, investable cash on the sidelines. Certainly not all of it, right? I know a lot of that is money that maybe has moved out of deposit accounts after the Silicon Valley Bank failure. We saw a lot more money shift from checking accounts and things into money market funds. So some of that has come from that, and we wouldn't necessarily call that investable. Some of that is also things like escrow. If you're buying a house, your money's set in escrow that can be held in money markets too. So it's not that all of it is going to be coming into equity markets, but we do think there's a pretty good chunk. And historically, when you look at cash yields, when they tend to fall below 3.5%, certainly 3%, is when you start to see that money come out of cash funds and move other places. I would argue that both US and international equity markets are going to be recipients of that cash, but we think that it can be kind of the impetus for another leg higher, or certainly a support in the equity markets right now. And really, in terms of the buying power of particularly US stocks, it's just firing on all cylinders. We are seeing record amounts of corporate buybacks, so companies buying their own stocks instead of maybe paying dividends to investors. We're seeing households, who are the largest holder of US equities with all this cash on the sideline, continuing to buy stocks as well. And then I think what we've seen in some of the fiscal policy from the US is that will be relatively stimulative as well. So there's more cash flowing into the economy that's going to need to find somewhere to go. So we do think that markets can continue to move higher from here. The earnings growth component, the fundamental side is one really important one that we're going to get more information on in the next couple weeks here. And the other side is really just a demand equation. There is a lot of cash on the sidelines. It needs to be invested, especially if, as you said, the Fed is going to start cutting interest rates, and that happens absent a recession. So if we don't have a recession to worry about, cash rates are falling, should really be thinking about, getting off the sidelines.
To this point here, we've talked a fair bit about fund flows, regionally, US, international, et cetera. And we just talked about fund flows from an asset allocation perspective, cash to equities. Now, a couple of years ago, we saw, it was a beta market. We had the S&P 500, see significant gains, but primarily driven by the Mag 7, which of course is driven by the AI theme. So it was flows into the technology sector. What are you seeing from a sector perspective? Has that shifted recently? I know obviously earlier in the year it seems like the Mag 7, again, hitting all-time highs, at least some of them. But are you seeing from a sector perspective fund flows into any particular area outside of technology?
Yeah, and we've been arguing that we need to come up with a new acronym. We've seen the Mag 7 break up a bit this year, if you will, both in terms of performance and sort of how they're approaching AI and where they are in the relative kind of horse race there. What is interesting when we look kind of one level down, so not just at the index level, but sort of underneath it. We are still continuing to see flows into the tech sector. That has become a very retail driven part of the equity markets. And retail investors have been some of the most active over the last few years. So we've continued to see allocations there. To put it in the framing that they usually do, they love to buy the dip, and they have continued to buy the dip throughout the course of sort of the drawdown that we saw in Q1, and then the really sharp recovery that we saw in Q2 as well. What I think is a little bit different than what we've seen over the last few years is we're also starting to see more flows into the value part of the market. So we've been arguing, if you look at the S&P 500, it doesn't really look anything like it used to even 10 years ago in terms of the breakdown of what you get of the mix of value and growth types of exposures. It's one of the reasons why we're arguing that you don't need to be quite as concerned about high valuations, because comparing an index that's mostly growth stocks of today to an index 10 years ago that was much more evenly split between growth and value, it shouldn't trade at the same value, right? Or the same valuation. But we've seen pretty strong performance from value relative to growth in the first half of the year, which is a sharp reversal of what we've seen over the last kind of 2 years or so. And so we've seen more flows being allocated there. And specifically, if we think about the sectors within that, certainly financials has been one that's gotten a lot of attention, especially around the deregulation agenda here in the US. And so we've seen, pretty good performance, and we've seen pretty strong flows as a result of that as well.
I mean, it sounds like it's a pretty stable and solid picture economically. We've got corporate profitability being maintained. We've got unemployment numbers that continue to defy, I guess, the macroeconomic expectations. Interest rates are expected to fall throughout the rest of the year. What can go wrong? What are we overlooking? What's gonna shake the market? I mean, even this, new 50% tariff on Brazil, the market yawns at it. I mean, it just seems like we've become to some degree complacent. I would argue with some policy, but what's gonna cause the next hiccup in these next 6 months?
Yeah. So, I mean, I was formulating a question as you were talking until you threw in the last 6 months. And then it's a slightly different question, right? I think, we do think that the economy is on pretty solid footing. We think that the global economy growth is going to be more diverse than it has been. It's not only going to be powered by the US. We're going to see growth from different regions as well. And that is definitely a good thing in terms of diversification. But I don't want to lose sight of the fact that, like, even though growth is still strong in the US and in North America broadly, and we don't think that we're going into a recession, we can't really ignore the fact that growth does seem to be slowing. So it's not stalling, it's not stopping, but it is slowing. And so, I think that, looking at the jobs report, which you mentioned, that we got, the day before the 4th of July holiday here and a half day in the market. So maybe markets didn't respond to it quite as much as they normally would have. The headline was really good and the details were really not that great. So we mostly saw job growth, even though it was a lot higher job growth numbers than we were expecting to see and than we've had in previous quarters. It mostly came from more seasonal type of work. It was concentrated in just a few sectors of the market, but actually most of the economy saw job growth slow pretty meaningfully. So I think that, the rest of the year is going to be about the details and not just the headlines of where are we starting to see weakness, where are we seeing that slowdown, and should we be watching to see if it accelerates. So I think that's part of our argument too for why, you certainly don't want to put all of your eggs in one basket, even though we're seeing strong corporate growth. economic growth is slowing a bit. I also think that the policy that, to your point, the market has wanted to just look through and sort of trade past hasn't actually hit the economy just yet. So we talked a lot about tariffs, and obviously there was a huge, reaction to the tariff announcements in March and in April. But we actually don't think they've reached our shores yet. So if you think about the lead time in terms of, inventory, a lot of US companies bulked up their inventory in anticipation of these tariffs. It typically takes a few months for a company to draw down its inventory, during which time it's replacing that or replenishing that with new orders. They built out even more of a runway of that, knowing that these tariffs were coming. So it's only been a few months since the tariffs started. We still may be getting some of the impact from tariffs from that perspective. Also, shipping times take a while too. So if, the tariffs are being assessed on based on when a ship leaves a harbor, not when it arrives at a US port. And so there can also be months lag between when we start to see prices or goods kind of pick up, just based upon when they were shipped and when they left the factory in the first place. So I don't think we're out of the woods just yet in terms of tariffs. We're still looking to see what that looks like. We're certainly seeing a lot of dynamism around how countries and how companies are able to adjust and react to them. But, I don't think we've had the full force of what it can look like once they're finally implemented in whatever their final form looks like. So growth is slowing. Tariffs are probably still coming. So it's not that we're without risk. It's just that there's still reasons why we think it makes sense to invest, just to be really smart about it. As I know you guys are, and thinking on a kind of a more diversified path of how to keep investors and, how to make sure that we're protecting, our investors' retirements.
So Kristy, on top of those two risks, which are, the economy and trade, which are interrelated, of course, the two other things I think about, and I'm curious when you're talking to institutional investors, are these top of mind, or are they kind of now completely off the agenda? One is the US debt load, which obviously for years the US government, but also investors have kind of kicked the can down the road. And then also geopolitics. And, the most recent instance was, the 12-day war, Israel and Iran. It seems like that's just gone from the headlines. I don't necessarily think that's over permanently. You've got Russia, bombarding Ukraine more than they ever have, recently. Are those issues that are being spoken about, and are those keeping people up at night, like institutional investors, or are they completely off the radar again at this point?
Yeah, so our chief investment officer for our fixed income business has a pretty now famous saying that the market can only focus on one thing at a time. And right now, the things that it's not focusing on are geopolitics and, at the moment, kind of debt and deficits. That's not to say, though, that the institutional investors that we're speaking to aren't thinking about those for the long term. And I think that's manifesting itself in two really specific ways. So on the geopolitical front, we've seen and heard from our investors that we speak to that there is just a much higher demand to hold gold, because gold historically, well, it hasn't necessarily proven itself as a great inflation hedge, at least over the last couple years worth of inflation and pandemic era inflation. It is a much better hedge for geopolitics. So to the extent that there is demand to sort of de-dollarize a portfolio, I think one of the landing places for where that's going and what they'll hold instead as a store of value is gold and precious metals more broadly. So I think that that's one way that we've seen it. We've seen a huge jump in fund flows in terms of where we've seen people allocate to gold in the past versus where they're doing so now. And then anecdotally, we have a lot of conversations with investors about it too. So a little bit probably makes sense in a portfolio from that perspective. And then on the debt and deficit side, the main place this is manifesting itself is in kind of an aversion to holding long dated treasuries. So, it's probably one of the most consensus views on the street and from investors that we speak to. Nobody wants to hold long duration right now. And the main reason why they don't is because of the debt and deficit. And they think that there should be a higher term premium. So how much more investors demand to buy your 30-year debt compared to your 20 or your 2-year debt or your 5-year debt. And so I think that we continue to see investors move away from long duration as their primary source of ballast or diversification in a portfolio. So that's really, popped up in a lot of different places, and investors are looking at alternatives. Institutional investors are allocating to private markets, to infrastructure, to hedge funds, in a much larger and more meaningful way than they have in the past, because we've seen, those deficit worries bleed over into long duration and what long dated treasuries can offer. And also they impact the diversification benefits of what bonds can do. So we've seen stock bond correlation, meaning they move together more often as opposed to moving apart. And so as investors are building portfolios, especially institutional investors, they're just looking to a broader kind of set of portfolio tools to build a balanced and diversified portfolio.
And it's kind of like a concerning trend if that continues, and all of a sudden you've got growing deficits adding to the debt. You've got higher interest rates if no one's willing to fund that US debt at current rates, and you've got a potential issue at some point. As I continue to say on this podcast, the debt is going to matter at some point. It just doesn't seem to matter at this point. So well, I think we've covered a lot in today's conversation. I think it was super interesting. Craig, any final questions or comments on your side?
No, I think it's great insight to see for someone like yourself who's got boots in the ground, and where again, money's actually moving, and what investors, both retail and institutional, are doing with their money. So it's a lot of value. So thanks very much, Kristy. Appreciate that.
Of course. And if I can close and just throw in one fun fact here, and also fun fact, I guess, they go hand in hand around here. We haven't really talked all that much about Canadian equities, but one thing that I wanted to say, I had just been talking to some of our portfolio managers in our systematic business. So like the quants, as opposed to the fundamental investors, if you will. But interestingly, right now, Canada is one of their largest overweights in terms of how they're allocating to different countries and regions. They have a country rotation fund, if you will. So they're just moving between different countries and trying to generate alpha that way. Canada's their largest overweight at this moment, which I found really interesting heading into this conversation. Some of the reasons for that, one is because they're seeing equity, earnings revisions trending much more positive. And then the second one is because they have an indicator that they've built using, AI and large language models, that they just think sentiment is too negative. And so because sentiment is too negative, they think that there's going to be more of a rebound even than we've seen so far. So all of that to say is, at least on a tactical basis, here we actually are kind of moving overweight and like Canadian equities for at least the next couple months as we see what plays out. But yeah, I thought I would end on a note of making sure that we're all friends here at the end of the day.
Well, that's great for your good friend Jay Snyder here, because for forever and a number of these podcasts, he's been holding his breath on Canada. It'll be Canada's turn at some point. We'll get it right, and maybe that's a sign by the quants that Mr. Snyder here might be correct at some point, and at least he has been so far this year. So we'll see.
That broken clock argument, right? Got it at some point.
So much potential. I'm going to be right at some point. We're going to have
every broken clock right twice a day.
Yeah, well, thanks a lot, Kristy, for your comments.
Of course. So much for having me.
Thanks, Kristy, and thanks everyone for joining us. As always, we appreciate any feedback. We hope you enjoyed the conversation and look forward to seeing you next time.